Investors start with $10,000. Same age, same income, same starting day. One buys the S&P 500, the other buys a hand-picked portfolio of individual stocks. 20 years later, their accounts look very different, but not for the reason you think. This isn't about intelligence, it's about probability. Let's break this down. Index investing has one job: match the market. If the S&P 500 goes up 10%, you go up 10%. If it drops 20%, you drop 20%. No hero plays, no big bets, no prediction required. You own 500 of the largest companies in America: Apple, Microsoft, Amazon, JP Morgan, Johnson & Johnson. When winners rise, they automatically become a larger part of the index. When losers shrink, they fade out. It self-adjusts. It evolves with the economy. Stock picking is different. Its goal isn't to match the market. Its goal is to beat it. Pick the next Nvidia, the next Amazon, the next 10-bagger. Sounds attractive, but here's the uncomfortable data. Standard & Poor's releases something called the SPIVA report. It tracks how many professional fund managers outperform the S&P 500. Over a 10-year period, around 85 to 90% of active managers underperform. Not amateur investors, professionals, teams of analysts, data models, research budgets. Most still lose to a low-cost index fund. Now, pause. If professionals struggle to consistently beat the index, why do beginners assume they'll do better? Ego. Because stock picking feels productive. You research, you analyze charts, you read earning reports, you feel in control. Index investing feels passive, almost lazy. But investing is not about feeling smart, it's about compounding capital. Let's talk bull markets. Over the last 50 years, the US stock market has gone up far more often than it has gone down. Roughly 40 out of the last 50 years were positive. The average bull market lasts about 3 years. The average bear market lasts less than 1 year. Markets rise more than they fall. Index funds thrive in this environment. Why? Because they hold the winners automatically. In a bull market, momentum carries the biggest companies higher. The index concentrates into those winners naturally. You ride the wave without guessing. Stock pickers, on the other hand, must choose correctly. Miss a big winner, your portfolio lags. Avoid a stock that multiplies tenfold, you feel it. Now, let's flip to bear markets. During downturns, active managers sometimes look smarter. In 2022, when markets fell sharply, nearly half of active managers outperformed the index. Why? Because they could shift to defensive sectors, hold cash, reduce exposure. Index funds don't do that. They take the full hit. So, here's the tension. Index investing wins over long periods. Stock picking sometimes protects better during downturns, but that protection comes at a cost. Fees. Most index funds charge microscopic expense ratios: 0.03%, 0.05%. Actively managed funds often charge 1% or more. That 1% doesn't sound dramatic, but over 30 years, a 1% annual fee can reduce your final portfolio value by hundreds of thousands of dollars. Fees compound negatively. And then there's trading. Stock picking usually means more buying and selling, more decisions, more taxes, more room for emotional mistakes. Research consistently shows the more the average investor trades, the worse their returns. Overconfidence is expensive. Now, let's talk risk. An S&P 500 index fund spreads your money across 500 companies. If 40% of your portfolio sits in one company and it falls 60%, your account takes a severe blow. Concentration builds fortunes. It also builds regret. And most beginners underestimate variance. Stock picking doesn't just increase potential returns, it increases outcome dispersion. You might outperform the market dramatically. You might underperform for decades. Index investing narrows the range of possible outcomes. It reduces catastrophic failure. Now, imagine something. In 1982, Home Depot was a young company. If you'd invested $1,000 and reinvested dividends, it would be worth millions today. But here's the catch. There were dozens of other competitors in 1982 that didn't survive. Hindsight highlights winners. Real-time investing hides uncertainty. It's easy to point at success stories. It's harder to live through the uncertainty of picking them. Now, consider this. Warren Buffett, arguably the greatest stock picker in modern history, recommends that most investors use low-cost index funds. In 2007, he made a public bet: an S&P 500 index versus a group of hedge funds. Over 10 years, the hedge funds returned about 36% total. The index returned about 125% after fees. Buffett wasn't guessing. He understood arithmetic. Now, let's be fair. Stock picking isn't wrong. It just requires discipline most people underestimate. You need deep understanding of financial statements, patience through underperformance, emotional control, realistic expectations, time commitment. Stock picking is not part-time gambling, it's full-time analysis. And even then, probability isn't guaranteed. For most investors, a hybrid approach works. A core portfolio in index funds, a smaller allocation, maybe 10 to 30%, in individual stocks. This allows participation in potential outperformance without risking everything. It balances ego and stability. But here's the real danger: strategy switching. When markets rise, investors chase stock picking. When markets fall, they retreat to index funds. They move based on emotion. They abandon systems at the worst time. And this behavior gap is costly. Studies show the average investor underperforms the very funds they invest in, not because the funds are bad, but because timing is poor. The biggest variable isn't strategy, it's behavior. Index investing wins if you stick with it. Stock picking wins only if you execute it consistently and skillfully. Both fail if you panic. So, what's the final answer? If your goal is simplicity, low fees, statistical probability, and long-term wealth accumulation, index investing has the edge. If your goal is outperformance, intellectual engagement, and you accept volatility, stock picking can work. But understand the odds. One approach leans on market growth, the other leans on personal skill. Over decades, markets trend upward. Human emotions fluctuate wildly. Betting on capitalism has historically been safer than betting on personal brilliance. In the end, the question isn't which one can make more. The question is, which one can I follow consistently for 30 years? Because in investing, consistency beats intensity, probability beats ego, and survival beats brilliance every time.